So the two of you have saved up $70,000. That's serious. You've worked hard, you've been disciplined, and now you're sitting on a financial foundation most people dream about. The big question is, should you now invest all that money in real estate or the stock market? Let's walk it out. No hype, no fluff, just real talk with a smart breakdown of where that money could take you by 2035. Let's start with real estate. With $70,000, you can make a 10 to 15% down payment on a home worth about $500,000. That's the magic of real estate. Leverage. You're controlling $500,000 in property, with just a fifth or less of that in cash. Over the next decade, experts predict housing prices could grow about 3 to 4% a year, depending on where you buy. So a $500,000 house could be worth over $650,000 by 2035. That's $150,000 in added value. And that's before rent income, tax perks, or the mortgage getting paid down month by month. Sounds like a no-brainer, right? But here's what people don't talk about enough. Managing a $500,000 asset comes with $500,000 size problems and responsibilities. A roof replacement? That's $10,000. New HVAC? Another $6,000. Water heater goes out? Add a few grand. Plumbing issues? Electrical updates? Foundation cracks? They're not if, they're when. These aren't just-in-case scenarios. They're guaranteed at some point, and they don't care about what you're dealing with at the time. You've also got insurance, which keeps rising, especially in places dealing with storms, wildfires, or floods, and property taxes, which only go in one direction, up. Let's not forget interest rates. If they go up, your mortgage gets more expensive. That could shrink your cash flow or make refinancing tricky if you're planning to pull equity out later. Real estate can build serious wealth, no question. But it's active, it's messy, and it's not something you just set and forget. Now let's flip the lens to the stock market. With $70,000, you can build a fully diversified portfolio. ETFs, index funds, even dividend stocks, and never think about leaky toilets again. The S&P 500 has historically returned 8 to 10% annually with dividends reinvested. That could more than double your investment to $180,000 by 2035. That's $110,000 in growth with no property tax, no repairs, no tenants, and yeah, no waiting on contractors to show up. And if you need some money, you sell and it's in your account within a day or two. Full liquidity if you ever need it. But yes, the market has its mood swings. Some years it's awesome. Some years it punches you right in the gut. But over time, especially over a 10-year period, it has an incredibly strong track record. Historically, in the last 90 years, any 10-year period, the S&P 500 has been positive 94% of the time. That's not a guarantee, but it's a trend worth respecting. The trade-off? There's no leverage here, just straight-up compounding growth. But you also don't get hit with a $8,000 roof bill out of nowhere. So what's the better move? If you're the kind of couple that wants to be hands-on, doesn't mind rolling up your sleeves, and you're ready to handle the financial swings of owning a big asset, real estate could absolutely be the right call. But if you want something more peaceful, predictable, and low maintenance, and you're okay growing your wealth more steadily, the stock market might be your better bet. And honestly, there's no wrong answer, just the one that matches your lifestyle. That $70,000 isn't just savings, it's your shot to shape your next decade on your own terms. So, what are you building with it? Let us know in the comments below.